Welcome back to Management Accounting. In this video, we are going to learn the classification of cost. Under this video, I am going to cover the elements of cost of products and services, cost classification for different purposes, as well as cost estimation based on high-low method, scatter diagram, and regression. Now let's identify what is cost. Cost is a resource sacrificed or foregone to achieve a specific objective, such as acquiring a good or service. Or sometimes it is known as the cash or cash equivalent value sacrificed for goods and services that are expected to bring a current or future benefit to the organization. Now let's look at the elements of cost. It includes material cost, labor cost, expenses, as well as overheads. Now let's look at the difference between unit cost and cost unit. Unit cost is the cost of an individual product or service. It can be calculated by dividing the cost with number of units, whereas cost unit should always be related to some object or item or function or a service. A cost unit is a measure of product, service, or time that can be used to determine or represent cost. Now let's see different industries or services and their cost units. In printing, we can use per job or square feet as the cost unit. For transportation, per ton per kilometer or per passenger per kilometer can be used. For a hospital, per patient day can be used. For gas, we can use per cubic meter. For road contractors, they can use kilometers as the cost unit. For hotels, number of bed nights can be used as the cost unit. When it comes to electricity, per kilowatt per hour can be used. When it's relating to the ready-made garments, number of garments or a unit of garment can be used as the cost unit. For petrol or other fuels, we can use number of liters or liter as the cost unit. For bakery, we can use per bread as the cost unit. Now let's see what is a cost object. According to Chartered Institute of Management Accountants, it is anything for which cost can be ascertained. A cost object can be a product, service, center, activity, customer, or distribution channel in relation to which costs are ascertained or calculated. A cost collection system normally accounts for cost in two broad stages. Firstly, it accumulates cost by classifying them into certain categories, such as labor, material, and overhead. Secondly, it assigns cost to cost objects, such as in an academic institute, the cost object may be a student. In a bakery, it may be a loaf of bread. Cost center is a production or service, a location, a function, an activity, or an item of equipment for which costs are accumulated. In other words, a cost center is a collection of place for cost. So now let's see different types of cost centers. A service location may be a cost center such as store, canteen, or it may be a functional activity such as sales, marketing, packing, or it may be an item of equipment such as photocopier machine, scanner machine, etc. There are 6 major types of cost centers that do not generate profit on their own, but they are really important to the core functions of the business. The first one is the impersonal cost center. It deals with equipment, machinery, or locations, such as R&D department. R&D department is there to find new solutions to the customer problems or design new products. However, the cost cannot be accumulated to that particular center itself, since it's not doing the manufacturing process in that department. Second one is the operational cost center. It concerns with people or machines that are engaged in similar activities, such as IT department. IT department makes sure that hardware, software and networks are all working correctly to have a smooth function in the production flow or in other departments. Next one is the personal cost center. It deals with particular person or group of people, such as HR department. It deals across the organization to recruit or acquire new employees and motivate employees. Next one is the product cost center. Product cost center deals with specific product or manufacturing area, such as a publishing company may have a production department that is specially responsible for the actual printing of its books, newspaper or magazines. A manufacturer might have assembly, painting or welding shops that particularly designed for a particular product. Next one is the process cost center. Process cost centers focus on specific processes or events. For example, customer service department. It handles customer complaints and improve customer experience and manage any warranties that might be available. So it's really important for the core function of the business. Finally, the service cost centers. It provides services to the company. For example, sanitary staff. They may function clean, orderly facilities so that employees can be healthy, safe and productive. Now let's see how we are going to classify the cost. Firstly, it can be classified according to their nature. That is material, labor, as well as expenses. Secondly, it can be classified according to the purpose, such as direct or indirect. Direct cost that can be directly identified with the cost unit or object, such as direct material, direct labor, direct expenses. Whereas indirect cost that cannot be identified directly with the cost unit or object, such as indirect material, indirect labor, and indirect expenses. Now let's see how this cost and cost element is impact on the production cost based on their purpose. So firstly, you know that there are three cost elements: material, labor, and other expenses. So this material, labor, and other expenses can be classified into direct and indirect. The direct cost is adjoined or combined together, and it's known as the prime cost. And when we add the indirect cost itself, it's known as the overhead. This overhead can be classified into production, administrative, as well as sales and distribution. Now this cost card will give you a better understanding how cost classified and impact on the production cost. Firstly, we are going to take the direct material, direct labor, and direct expenses. These three is categorized into prime cost. Then to the prime cost, we are going to add the production overheads. Then we are getting the production cost. Then to the production cost, we are going to add the administrative overheads as well as sales and distribution overheads. Then we are getting the total cost. In a manufacturing organization, in the traditional costing system, accumulate the product cost as follows. First, they are going to identify the overhead into two parts: manufacturing as well as non-manufacturing overheads. The manufacturing overheads includes factory overheads, including supervisory cost, depreciation for factory equipment, factory rent, etc. And non-manufacturing overheads include administrative overheads, sales and distribution overheads, finance expenses, etc. When we add the prime cost to the manufacturing overheads, we are getting the total manufacturing cost. Then when we add the non-manufacturing overhead to the total manufacturing cost, we are getting the ultimate total cost. Now, let's classify the costs according to the cost behavior. Normally, based on the cost behavior, cost can be classified as variable cost, fixed cost, semi-fixed cost, as well as semi-variable cost. But you have to remember the classification of cost depend on the time period involved. In short term, some cost may be fixed, some cost may be variable. But in the long term, all the costs are variable. Variable cost directly change with the activity level, which means the quantity of output. As production quantity increases, the cost increases, and as the production quantity decreases, so do the cost. The best example would be direct material, direct expenses, as well as direct labor. So when you go through the graph, you can see the total variable cost has increased with the activity level. When it comes to per unit variable cost, you can see it is fixed with the activity level. Fixed cost will remain constant over the wide range of activity, such as rent, depreciation. So when you see the total fixed cost graph, you can note that even though the activity level has been increased or decreased, the total fixed cost is remain constant or fixed. over the activity level. However, when we are going to see the unit fixed cost, you can see it has been decreased based on the activity level. This may be due to economies of scale. Semi-fixed costs are fixed within specified activity level, but they eventually increases or decreases by some constant amount at critical activity levels. Expenditure that increase in total as activity level rises, but in a stepped rather than a linear function. Staffing and facility rent would be the best example for semi-fixed cost. Just imagine the cost of one supervisor may be required for a particular range of activity. Although above this level, the cost of an additional supervisor would be incurred and it will be added to the total fixed cost. Therefore, it would be stepped up. Semi-variable costs include both a fixed and a variable component, such as telephone charges, power, and port charges. There may be a fixed charge plus an additional cost based on the usage. Cost can be further classified based on their controllability into controllable as well as uncontrollable cost. Controllable costs are the costs that can be directly controlled by the managers. These costs can be minimized by using their skills, such as fuel, stationery, telephone, etc. Whereas uncontrollable costs are those costs that cannot be controlled by managers. They cannot be minimized by using their skills, such as taxes, rates, etc. Let's see the difference between the period and product cost. Period costs are not attached to the product and are included in the inventory valuation, such as selling expenses, advertising expenses, depreciation expenses, etc. Product costs are costs that are attached to the product and included in the stock, such as direct material, direct labor, and manufacturing overhead. Now let's see how we are going to treat these product and period cost. Normally, the product costs are initially recorded as an asset in the statement of financial position under the inventory. Once these related goods are sold, it will capitalize and charge to the expense under the cost of goods sold. Normally, period costs are always expense on the income statement during the period which they are incurred. Let's see the difference between the avoidable and unavoidable cost. Avoidable costs are those costs that can be saved by not adopting a given alternative. For example, a manufacturer with many product lines can drop one of the lines, thereby taking away the associated costs such as labor and material. Whereas unavoidable costs cannot be saved. These costs should be still incurred even if the activity is not performed. Some examples include depreciation on equipment, property taxes, lease payment, interest expenses for loans, etc. Avoidable and unavoidable costs are alternative terms sometimes used to describe relevant and irrelevant costs. Now let's see the relevant and irrelevant cost and revenues. Relevant costs and revenues are those future costs and revenues that will be changed by a decision. A certain matter is relevant if the decision results in a change in cash flow. The change in cash flow can be either an extra amount that must be paid or a decrease in the amount that must be paid when it comes to cost, or an additional revenue that will be earned, or a decrease in revenue that will be earned. Irrelevant cost and revenue will not be changed by a decision. For example, irrelevant costs are sunk cost, committed cost, or overhead, as these cannot be avoided. Sunk costs are costs of resources already acquired and are unaffected by the choice between various alternatives, such as depreciation, market research. These sunk costs are irrelevant for decision making, since it has been already spent. Whereas opportunity cost is a cost that measures the opportunity or profit that is lost or sacrificed when choosing one alternative and foregoing other. It can be defined as the potential foregone profit from a missed opportunity. Opportunity cost is relevant for decision making. Now let's see how we are going to estimate the cost. Cost can be estimated by using either one of these methods, high-low method, scatter diagram, or the regression. High-low method is used to calculate the cost and variable component of a cost. This includes taking the highest and lowest level of activity and comparing the total cost at each level. It can be used to select the fixed and variable cost of a product, machine, store, geographic sales region, product line, and so on. For example, fixed cost in the product's production cost may include employee wages and rental expenses, whereas variable costs include costs incurred in purchasing raw materials. So we can use this method to classify them easily. First, we have to find the variable cost. For that, we have to take the difference between the highest and lowest activity units, and we have to divide it with the highest and lowest activity cost difference. Then, we have to find the fixed cost. To find the fixed cost from the highest activity cost, we have to deduct the variable cost. That is, variable cost per unit into highest activity units. Then we can find the high-low cost. That is the fixed cost plus the variable cost. Next method is the scatter diagram. The scatter diagram method of cost estimation measures the graphical representation between the total production and total cost of a firm, where the total production is stated on the x-axis or the horizontal axis and the total cost is stated on the y-axis or the vertical axis. This method is most useful for gaining the insight into the nature of mixed cost. Mixed cost is the cost that has both fixed as well as the variable component. This can be used to project the cost based on the expected activity levels. A scatter graph analysis can be lead to the formulation of more accurate budgets. Regression analysis is another type of cost estimation. Regression analysis refers to a technique for estimating the relationship between variables, which means the independent and dependent variable. It helps people to understand how the value of dependent variable changes when one independent variable is variable while the others held constant. Regression analysis is used in forecasting future data. It can be either cost or revenue. There are two methods of regression analysis: linear regression, and the other one is the multiple regression. Now, we are going to learn the linear regression. Linear regression is a method that studies the linear relationship between variables. The linear regression can be calculated by using the following formula, where y is the dependent variable and x is the independent variable. So b represents the slope of the regression line and a is the intercept of the regression line. So here the residuals are represented with this icon E. This is the end of chapter 2. In this chapter, you have gained the knowledge with regarding to the elements of cost of products and service and how we are going to classify the cost based on different purposes, and finally, what are the methods used to cost estimate. I will put another video to wrap up the cost estimation. So keep in touch and stay with us. Thank you.